Welcome to Get Rich Education. I'm your host, Keith Weinhold. How will your economic future look over the next 3 to 10 years? It's partly dependent on the future direction of the larger economy and interest rates and inflation. Learn exactly where we're headed and how you can use it to increase your prosperity with a great guest, and some quick bite-sized lessons on debt, inflation, and interest rates so that you know how an economy works today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Lakeland, Florida to Lake Powell, Arizona, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. If you want to clip coupons on your road to wealth, I'm here to tell you right now, this is not the show for you. I'm not saying that you can never do those things, but see, one day, eventually, everyone arrives at the understanding that no one shrinks their way to wealth. If you're interested in financial betterment, well, then a path for you that is both shorter and it's a path that reduces the amount of time that you will struggle is to instead focus on those activities that really move the meter in your life, like what we're talking about today. In fact, this is not even the show for you if you have a goal of, say, becoming a millionaire in 30 years. That's thinking rather small. It's not forward thinking at all, because at just a 4% inflation rate in 30 years, $1 million net worth would be just $300,000 in purchasing power.
For $1 million.
Well, don't you think we should maybe ask for more than $1 million? $1 million isn't exactly a lot of money these days.
Yeah, that's from Austin Powers again. You have an excellent chance of becoming more than just a single millionaire here as you're expanding your means rather than only living below them. Before we bring in our terrific guest today, which is going to be awesome, we'll discuss the future of the economy, the interest rate you'll pay, the interest rate you'll earn, and how quickly your dollar's purchasing power is going to be deflated away. So let's discuss debt here first. Debt diminishes your wealth. Yes, there's good debt and bad debt. We leverage good debt here, sure. But just keeping things basic, to make my point here, say that you take out a long-term loan with a 5% interest rate that you need to pay for borrowing the money. This could be for real estate or any sort of loan. Realize that although your debt's interest rate is 5% this year, and it's also going to be 5% next year, it can still diminish your wealth at a different rate each year. Well, now, how could that be? It's because of inflation. That's because if there's 2% inflation this year, then that 5% debt really only damaged your prosperity by 3%, because that's 5% interest minus 2% inflation. Therefore, the debt only damaged your prosperity by 3%. That's this year. But if inflation goes up to 5% next year, well, then the debt will not dent your wealth at all, because you've got 5% interest minus 5% inflation, and therefore there isn't any change in your prosperity. And this is why debtors want higher inflation and why savers fear higher inflation. I've discussed that before. Now, if inflation rises and becomes higher than the 5% interest rate on your debt, well, now borrowing money actually increases your prosperity. And that's true even if you had to pay it back yourself. Of course, it gets even better when the tenant pays this mortgage back for you. then in that case, both the tenant and inflation are accelerating the paydown for you. So interest rates and inflation affect real estate investors more than most people because real estate investors have big debts, and big good debt, that is. When we talk about how broader economics affect you, understand that there's a difference in the United States between fiscal policy and monetary policy. Fiscal policy is controlled by the House Ways and Means Committee, and what the House Ways and Means Committee does is raise or lower taxes and raise or lower spending. Now, monetary policy, on the other hand, that is the Federal Reserve's role. The Federal Reserve is the body that expands or reduces the money supply, which in turn regulates inflation, and the Fed also raises or lowers interest rates. That is why we talk here about the Fed sometimes, like Chris Martenson and I did 4 weeks ago. To review, the House Ways and Means Committee enacts fiscal policy, which includes government taxation and spending, and the Federal Open Market Committee sets monetary policy, controlling interest rates and inflation. As we're about to talk about economic forecasting, let's set the table for where we're at. In the final quarter of last year, GDP grew at a 2.1% annual rate. Yes, that's growth, but it is slow growth. One reason that might have led to the fact that you are in the longest economic expansion in American history right now is that the downturn in nearly all markets from 2007 to 2009 was so drastic and so severe that we dipped down to such a low base. Well, it takes more time and distance to crawl back up out of that unusually low base that we dipped down to about 12 years ago. Let's talk about the prospects for extending this longest expansion and making it even longer. This week's guest has served as CEO and chief economist of ITR Economics since 1987. In fact, ITR, they are the oldest privately held, continuously operating economic research and consulting firm in the entire United States. And today's guest is their leader. They research the business cycle and do economic forecasting to make businesses and people like you more profitable. And he shared his highly valued research results via presentations and workshops and seminars in a lot of nations across the world to hundreds of thousands of business owners and executives for the last 38 years. And he's here to conveniently deliver them straight to you in your earbuds or through your car speakers today for free. He is co-author of a book that has such an intriguing name, Prosperity in the Age of Decline. And the book is a powerful look at how to make the most of U.S. and global trends over the next 20 years. He also authored a guide named Make Your Move. That's insightful, and it helps increase your profits through inevitable business cycle changes. He also co-authored ITR Economics' first children's book called But I Want It. Welcome to Get Rich Education, Brian Beaulieu.
Thanks, Keith, and thanks for mentioning But I Want It. I love that book.
Yeah, so it's great to have you here. Recession fears peaked back in September of 2019. I've been following you, and your predictive research earlier did not indicate that a recession was coming at all. So tell us about that.
What we have been forecasting is that the economy would slow down over the course of the second half of 2019. And it is indeed slowing down. You look at the rate of growth in GDP, and you have to go back multiple years to find our economy growing this slowly.
Right.
And that deceleration process is going to continue through the first 1 or 2 quarters of 2020. Don't be surprised if in 1Q20 the recession fears get heightened even more. From our perspective at ITR, people that are worrying about, is there going to be a recession? How do I plan for a recession? They're asking the wrong question. The wrong question because they're looking at what's right in front of them. They're looking at their feet instead of looking down the road.
Yeah.
What we do is we look down the road and we look at leading indicators. And Keith, the leading indicators, we have a plethora of leading indicators, over 15 leading indicators. It's my dashboard of indicators. And they're flashing green with the exception of 3 of them right now.
One of them, classically, Brian, is the durable goods orders. Economists look at that in helping forecast when a recession might occur. You've got 15 of them.
Yes, in fact, we don't even use durable goods new orders because it doesn't lead by enough. We want indicators that lead by 6 to 18 months, the overall future, and new orders will lead by 1 or 2 months. So we need much better vision into the future than that. And our collection, our system of leading indicators are telling us that this US economy, and by extension, the global economy, will be getting stronger and stronger beginning in the second half of 2020. And we like what we're seeing for 2021. So rather than worrying about a recession, people should be figuring out how they're going to capitalize on the next acceleration trend that is coming.
Yeah, that's interesting. And just to be clear, a recession is defined as 2 consecutive quarters of a contracting or a negative GDP. We still got a positive GDP. It just isn't as high as it used to be. Brian, I think some people have this bias toward what I've heard some psychologists call declinism. Declinism is a person's predisposition to view the past favorably and the future negatively. And, really, this is despite the fact that we're living in the most peaceful and prosperous time in human history. It's at least easy to make that case, but yet many people believe things are getting worse. So tell us why you see the economy improving in late 2020 and into early 2021. Why is that?
Objectively, it's because the leading indicators are telling us that more people will be spending more money. Capacity utilization is going to be on the rise. CapEx is going to be on the rise. Stock market is already signaling that we're likely moving in that direction. Profitability should be showing some improvement based on our markers. You're absolutely right about people's propensity, though, to linearly extrapolate. They'll take what happened over the last month, the last quarter, the last 2 quarters, and they straight line that into the future. And beyond that, they tend to be reticent to accept an upbeat outlook about the future. They oftentimes will ask me, why are you being so optimistic? And I respond, I'm not being optimistic. I'm being realistic. I'm driving my expectations based on the numbers. But that's why we titled our book Prosperity in the Age of Decline. Everybody thinks we're in the age of decline, right? And they're going to miss out on a whole lot of prosperity that could be had. Because of who we're talking to today, Keith, one of our go-to areas when we're talking to audiences is real estate, whether that's personal or commercial. But investing in real estate is one of our must-do actions for this decade, the 2020.
I think you need to ask the declinist or inform them, come on, let's look at some metrics like life expectancy, levels of crime, levels of violence, or what you specialize in there, prosperity statistics, in order to tell us that things are actually getting better. They're not getting worse. Now, I don't know if they're getting better in every way. You bring up housing, real estate. We have a real estate investor listener. We're looking at the future. How important will housing be as a component of the economy for the decade of the 2020s? What are your thoughts?
We see housing as very much a driver of this economy going forward. What you and I haven't talked about yet, Keith, is the demographic trend of the United States. And it's vastly different than any other major economy on this planet. And it is favorable. It is positive. And that bodes exceedingly well for real estate. There are people out there that worry about, the millennials, they're not buying homes like prior generations did. Well, the millennials have delayed launching into adulthood. They're not particularly fond of adulting, using their words.
Right.
But they're getting it. In fact, surveys show that most millennial women have already moved out. If there's a millennial still in your basement, chances are it's a male, and that male will be moving out. How do I know that? Because the women have already moved out, and therefore the men will be moving out. That's a given. And people will sometimes worry, well, what about all this student loan debt? Well, as their incomes go up, managing the student loan debt becomes easier and easier. It's just like my generation. I'm a boomer. When we first got our mortgage, it was barely affordable, right? But as our incomes rose, it became more and more affordable until you didn't even think about it anymore. Incomes are going up now. They're going to be going up for the millennials. These loans, while they don't like them right now, who does like debt? They're just part of the fabric of life. We do not need to be forgiving these loans. It's not going to help the housing market in particular by forgiving these loans either. I don't see any big shot in the arm for the real estate market by doing so because of the offsetting negative impact it would have on U.S. fiscal status and interest rates. So there's no easy win there by forgiving that debt. The point is we have more and more people coming into being in this country, even with the slowdown in legal immigration. And that's a huge plus for us that they don't have in China, Japan, Europe, and any other major economy out there. We got it, and we should all be investing into that reality.
For a major economy, we still have a substantial enough population growth, and that's just economics 101, helping fuel the supply versus demand and increasing the demand for housing. Supply needs to continue to keep up with that. I think it's important to look at demographics. Millennials are a large generation, and the oldest millennials were born in 1977. It's 2020, so they're now 43 years old. So we have this increasing affluence of millennials. A lot of people don't realize Generation Z, just roughly that cohort born 1996 up to the present, they're even larger than the millennials yet. So when we talk about the future of housing and real estate, it's really important to look at these two demographic age groups and what they're doing.
That is so cool. You just touched on the cornerstone of why we can look forward to the future that other countries cannot have. And let me just add a little color to what you said about Gen Z. Surveys are showing that Gen Z, they want to stand on their own 2 feet. They don't want to be beholden to big government, and they don't want to be beholden to big business. They want to be beholden to nobody but their own abilities. And what that means, as to me as an economist, is, oh my gosh, we have this generation of entrepreneurs in the pipeline. And what more do you want out of a future than to have a generation of capitalist entrepreneurs in your future? Bring it on. I'm ready.
Yeah, that's right. Entrepreneurship is cool, and it might be cooler to Generation Z than it's ever been in any American generation, and that's really good for prosperity.
Absolutely. That doesn't mean, by the way, and I don't want anybody to think that I'm Pollyannish or ITR Economics is Pollyannish. There are difficulties out there, and that's part of prosperity in the age of decline. And we can't go blindly into this future. But through the 2020s, you and I have been talking about the trends that we all need to be capitalizing on, because they are going to be some of the most powerful trends for us to make money off of. Even with all that, by the way, and if I was a real estate investor, which I am, it's important to note that interest rates are likely going to stay relatively low for at least through 2023, in our opinion. That doesn't mean they're not going to go up, but we're not going to go back into a 70s type trend, even though the economy is going to be doing well. Part of that is also the demographics that you and I have been talking about. Us baby boomers, me again, we're in the savings mode, not the consumption mode.
Right.
And that means between that and all the money created by the central bankers across the world, there's a lot of money floating around out there that needs to be sopped up, if you will, before we start seeing interest rates rise.
I want to talk to you more about the future direction of interest rates and inflation shortly. But before we leave the prosperity discussion, in your opinion, are Americans experiencing real year-over-year wage increases? And I mean real is defined by what you think the real inflation rate is. I think a lot of people look at the target CPI that the Fed has of 2% as being somewhat farcical. I know you have other sources out there like Shadow Stats, even trying to make the case that the real diminished purchasing power of the dollar is between 10 and 12%. I don't know if it's really that high, but with respect to inflation, are Americans experiencing real year-over-year wage increases? What are your thoughts?
The short answer is yes, they are experiencing a real increase in their earnings, their wages. And I looked at it using not only the CPI, but the old calculation of the CPI. You know, the CPI is a modified Asperis index, just throw out some fancy talk. That formula was changed under Bill Clinton to intentionally understate inflation because it saves the government billions of dollars every year.
All those entitlement programs they have are tied to the inflation rate, sure.
Right. So we understate that so that we don't have to spend as much money. But they keep that old formula going. Some people prefer the GDP implicit price deflator, but that draws a lot of its data from the CPI. So there's no perfect measure out there. The bottom line, though, is when I look at earnings and adjust for inflation and even add some percentage points on top of that, earnings are indeed going up in real dollar terms, adjusted for inflation. Now, and this is where it gets interesting with the politicians. Politicians will say, well, incomes aren't going up. Well, they're looking at a different data set. I chose my words very carefully. I look at earnings. But if you also put into that sample base people on welfare, people who are not working, retirees, people who are of working age but have chosen not to work anymore, then incomes aren't going up. But that's because so many people are no longer in the working category by choice or education or whatever. But for people who are actually working, we're seeing real wage increases. And that's been true since 1979. This system of ours works if you're willing to work.
Brian thinks that interest rates are going to stay low for the next few years. I'm going to ask him why he thinks that, what he thinks about the future of inflation, and why do you, as a real estate investor, need to be concerned with what's going to happen in the stock market? You're listening to Get Rich Education. Our guest is ITR Economics CEO Brian Beaulieu. More when we come back. I'm your host, Keith Weinhold. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Brian Beaulieu, CEO and Chief Economist of ITR Economics, the oldest firm of their type that's been continuously operating in the entire United States. Brian, you told us that you expect interest rates to stay low, maybe not this low, but still relatively low for the next few years. Tell us why.
Basically, the whys are the demographics of the United States and the world really is such that we're looking at a net savings scenario more than a net consumption scenario for really the next 5 years. And also because we're in a low inflation environment, and that's true for many reasons. And that's going to carry through for the next 3 or 4 years also. Be aware, though, that the key is, relatively speaking, we're looking at long-term interest rates probably going up 300, 350 bips over the next 4 to 5 years.
3 to 3.5%.
Right. So it's not like they're going to stay on the floor, but over that long a period of time, 5 years, that sort of a rise isn't going to prove to be ruinous to anybody's lifestyle or investments. It gets trickier in the second half of the 2020s, in our opinion, because we're likely going to see more inflation, particularly here in the United States, because that's where I'm focused with my inflation thinking, in the second half. And that'll tend to drive those interest rates up higher, as you are well aware. Interest rates tag along with inflation.
There is a positive correlation with inflation and interest rates, which is a good and bad news story for a real estate investor, because in general, real estate investors are big borrowers. We'd like to have low interest rates and high inflation, so that high inflation erodes away the weight of our debt. But you don't usually have both. You have either one or the other, and then you have to get in and decide which side of that you're going to play.
Exactly. And, you use your leverage wisely, you choose the markets wisely. And by that, I mean the geographic markets. And, savvy investors know how to make all this work.
Yeah, 100%. Tell us more behind why you think the second half of this decade, the 2020s, we'll see this acceleration in both higher interest rates and higher inflation?
It boils down to some people are calling it de-globalization. I call it, take a look around the world and think about Brexit, Italy, Austria, China, Brazil, the United States, and others that are getting more and more nationalistic. It's me first. Everybody else is a very distant second. Globalization is what got us deflation. Globalization is what got us efficiencies, able to lower the rate of inflation because of those efficiencies. Competition got us lower prices, and interest rates are nothing but the price of printing money, right?
Right.
But as globalization falls by the wayside and we turn more and more protectionistic in our thinking and we reward inefficiencies, guess what? That breeds inflation, that breeds higher prices, and that means higher interest rates ultimately.
With this trend from globalization back to more nationalism, which is really interesting, and that being that underlying engine beneath greater inflation and higher interest rates. And really the good news, Brian, at least here in the United States, you can still tie up those long-term fixed interest rate loans. Therefore, you can get a low interest rate today, less than 4 or 5%, tie it up for 30 years. So even in the late half of the decade, if we do get this acceleration in inflation and interest rates, the real estate investor has their interest rate locked in, but yet they're benefiting from the higher inflation, putting upward pressure on the asset price, putting upward pressure on the rent, and deflating away the weight of one's debt all at the same time.
You have enunciated it perfectly, and you can't do that in Canada,
right?
But can do it here. I mean, what a great place to be, right?
It is. Yeah, you talk to Canadians, and they need to refi every 5 years to the prevailing mortgage interest rate. But in the United States, we have this astounding benefit of tying up that money for 3 decades. It's truly amazing. And a lot of people don't understand that, in a sense, a mortgage is an asset when you think about it that way and tie it to a cash flowing property.
It's an economic asset from my perspective. You got to do it now, though, which is what you were alluding to. You lock and load now. You don't wait on this. Don't wait for interest rates to go higher if you really want to maximize your potential. And if you're one of those folks that has this Eeyore outlook about the future, you miss out, which is why fortune favors the bold.
100%, right? It's about being a non-conformer. Conformers never do anything important in the world. So
that's true.
Now, Brian, I know that you have some important thoughts about the stock market and how that can affect an everyday consumer and even a real estate investor, therefore. Tell us about that.
We have some concerns about the direction of the stock market come, let's just call it 2022. That's far enough away in economic terms that it could be 6 months sooner. It could be in the latter half of 22. But the market is rising much faster than its corporate profitability in the US and indeed globally. And it's not that we haven't seen this before. It has happened before. And inevitably, it plays out not by profitability somehow accelerating to catch up to prices, but stock prices coming down to reflect the reality of profitability. In the long run, the market is efficient in that sense, even though it can be inefficient for years on end. And when we look at debt loads, when we look at ability to refi, when we look at this yawning delta between market valuations and profitability, we become very concerned about the direction of the stock market in 2022. That is likely going to put a damper on our real estate market. It's a business cycle. It's not the 10-year trend that you and I have been talking about so far, Keith.
Yeah.
And therefore, I see it as another buying opportunity. When this reset happens in 22, 23, I intend to be out there buying what I wish I had bought, or perhaps didn't have the money to buy today or even later on in 2020. You're going to get another run at this in 22, 23. And I just wanted people to be aware of constantly scanning, looking for those opportunities in the right markets. It always comes back to where are people moving to, where's the birth rate the highest, and those sorts of things, right? But you do this in the right markets, and you're going to love the ability to take advantage of this reset in 22, 23.
We've been looking at the short to intermediate term future here in the next 2 to 3 years. Maybe wrapping up, Brian, why don't you summarize actionable takeaways for how an investor can best position themselves here in 2020?
And know the demographics by state, not only the migration patterns within the United States, but the how fast is the overall population growing, which would take into consideration Gen Z and the next gen after that. That'll tell you what sort of housing you're looking at. You want to look at education levels within those markets also, because that also identifies what sort of housing you're looking at, whether it's a multiplex, whether it's single family homes, et cetera. And the education level tells you what they're eventually going to be able to afford, right? Do that homework and commit now. The leverage to be had is there. I was just looking at the numbers yesterday, Keith, and the banks are slowing down and other lending institutions have slowed down a little bit in terms of getting a little bit more cautious, but the window, as far as I'm concerned, is still wide open for any worthwhile investor, somebody who is credible as an investor. There's still a lot of money to be had out there. Make that move.
That's right. And paying attention to that local market is so important. And as we say around here at Get Rich Education, in real estate investing, the market is more important than the property.
Absolutely. I'll take that any day of the week.
Well, Brian, you've been providing great forecasts to businesses, executives, and just everyday people for decades there at ITR. What's the best way for our audience to learn more about you and your forecasting?
Well, thanks for that. Yeah, we have a very high forecast accuracy rate. Over the last 15 years, it's been averaging higher than 95% accuracy on our forecast. In the last several years, it's been north of 98%. So we're feeling like we're pretty dialed in. Best place to go is right to our website, itreconomics.com, and learn more about us.
Brian Beaulieu, it's been great having you here on Get Rich Education.
Keith, thank you very much. It's been a lot of fun.
Some of the favorite leading indicators there at their firm are the U.S. Purchasing Managers Index, because that leads the industrial economy by 9 to 15 months. Also, they track to what extent industry capacity is being utilized and a number of other indicators there. Brian Beaulieu even has material on what to expect in the 2030s and beyond. To recap some of what we learned today, Brian thinks we are experiencing real year-over-year wage increases after it's adjusted for inflation. He said interest rates should stay low, and inflation rates should also stay low here in the near term. Expect interest rates to go up 3 to 3.5% over the next 4 or 5 years. And by the way, he said expect them to go up 300 to 350 bips, and you saw me jump in there during the chat. So you know, a basis point is 1/100th of 1%. Sometimes you see it abbreviated as BPS, so sometimes economists just say it as bips. Back to our view, he feels that in the second half of the 2020s, we'll have more inflation, and inflation being correlated to higher interest rates, that will drive rates higher, de-globalization being that driver behind the higher interest rates and higher inflation that we should have in the second half of this decade. So that could be an ideal scenario for you if you lock in your mortgage interest rates now and expect inflation later in the decade. In fact, mortgage interest rates are so low that, you know what? Think of it this way. Today, almost every asset class out there has run up substantially over the last 10 plus years. Real estate of all types, stocks of all types, that sometimes it can seem hard for you to find any asset type that is severely undervalued. Well, if you think of the 30-year fixed amortizing mortgage as an asset when it provides you with leverage on a cash flowing property, with your tenant even making the payments for you, well, then the 30-year loan could very well be the most undervalued asset that you can find today. And yes, the rates are even lower than they were 10 years ago. And like Brian and I discussed, if inflation does indeed rise late in the decade like he thinks, you have really created a nice profit center for yourself. I actually found it remarkable that he and I had so many points of agreement on how you can specifically use future trends in the economy to make better decisions to position yourself and increase your prosperity. To review what you learned earlier, do you still remember the difference between fiscal policy and monetary policy? Do you? Fiscal policy is controlled by the House Ways and Means Committee. They raise or lower taxes and raise or lower spending. Monetary policy, on the other hand, that's the Fed's role. They expand or reduce the money supply. That affects the inflation rate. and the Fed also controls interest rates. They're the key differences between fiscal policy and monetary policy. We've got a lot of great shows coming up here in the next few weeks, including new ways to think about real estate investing, prosperity, mindset, and wealth building that you've never thought about before. I have a lot of ideas marinating inside my head to share with you. I'm constantly trying to make understanding investing simple and clear for you. If you've ever wanted to learn more about an episode here and look at the show notes, and that way you can see a photo of what our episode guest looks like and see all the resources for the episode, you can do all of that in just one place. Go to getricheducation.com/ whatever the episode number is. So today's episode, since it's 282, means go to getricheducation.com/ 282 and see the episode page with Brian's headshot and whatever other episode information you want to learn more about. Again, for example, today, that's getricheducation.com/ 282. Big thanks today to the Chief Executive Officer of ITR Economics, Brian Beaulieu. I like ITR because they're not afraid to go out on a limb and really make some specific trend forecasts. Check them out at itreconomics.com. Until next week, I'm your host, Keith Weinhold. Though you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, getricheducation.com.